In the United States, individuals engaged in trading activities must adhere to specific regulations and tax obligations. Understanding these requirements is crucial for compliance and effective financial planning. Regulatory framework for traders in the U.S. The U.S. financial markets are governed by a comprehensive regulatory framework designed to maintain market integrity and protect investors. Key regulatory bodies and regulations include 1. Securities and Exchange Commission, SEC. The SEC oversees securities markets, enforcing laws against market manipulation and ensuring transparency. 2. Commodity Futures Trading Commission, CFTC. The CFTC regulates commodity futures and options markets, aiming to prevent fraud and abusive practices. 3. Financial Industry Regulatory Authority, FINRA. FINRA is a self-regulatory organization that supervises brokerage firms and exchange markets, enforcing rules that govern the activities of registered brokers and broker-dealer firms. Classification of market participants. The Internal Revenue Service, IRS, classifies individuals involved in the buying and selling of securities into 3 categories: investors, traders, and dealers. Each classification has distinct tax implications. 1. Investors typically buy and hold securities for personal investment, seeking income from dividends, interest, or capital appreciation. They report gains and losses as capital gains and losses on Schedule D, Form 1040, and are subject to capital loss limitations and wash sale rules. 2. Traders engage in the business of buying and selling securities for their own account, aiming to profit from daily market movements. To qualify as a trader, one must meet specific criteria, including seeking profit from daily market movements, conducting substantial activity, and carrying on the activity with continuity and regularity. Traders report business expenses on Schedule C, Form 1040, and can elect the mark-to-market accounting method under Section 475 SF. 3. Dealers regularly purchase or sell securities to their customers in the ordinary course of their trade or business. They are distinguished from investors and traders by having customers and deriving income from marketing securities for sale to customers, or from being compensated for services provided as an intermediary or market maker. Dealers must report gains and losses using the mark-to-market rules. Tax obligations for traders. Traders have specific tax obligations based on their classification and the accounting methods they elect. 1. Reporting income and expenses. Traders report their business expenses on Schedule C, Form 1040. Commissions and other costs of acquiring or disposing of securities are not deductible, but must be used to figure gain or loss upon disposition of the securities. Gains and losses from selling securities are not subject to self-employment tax. 2. Mark-to-market election. Traders can choose to use the mark-to-market method of accounting by making a valid election under Section 475F. This election must be made by the original due date, not including extensions, of the tax return for the year prior to the year for which the election is intended to be effective. Under this method, gains and losses from sales of securities are generally treated as ordinary gains and losses and must be reported on Part 2 of Form 4797. The limitations on capital losses and the wash sale rules do not apply to traders using the mark-to-market method. 3. Net investment income tax, NIIT. Gains and losses from a trade or business of trading in financial instruments or commodities are not subject to self-employment taxes. However, interest expense and other investment expenses are deducted by a trader on Schedule C, Form 1040, if the expenses are from the trading business. A special rule may apply to a trader in financial instruments or commodities to reduce net investment income. The trader's interest and other investment expenses, to the extent the expenses are not used to reduce the trader's self-employment income, may be deductible for NIIT. Trading strategies for 2025. As the financial markets evolve, traders must adapt their strategies to stay competitive. In 2025, several trends and strategies are anticipated to be prominent. 1. Sector rotation strategy. Focusing on sectors with strong government policy support, such as green energy, infrastructure, and defense, can be beneficial. Traders should stay alert to macroeconomic cues like interest rate movements, which may impact rate-sensitive sectors like banking and real estate. Rotating funds across sectors based on market cycles and emerging trends can optimize returns. 2. Momentum trading in emerging themes. Identifying and riding trends early using news flow, FII data, and volume patterns can be advantageous. Utilizing tools like Bollinger Bands and MACD to confirm breakout or momentum signals is recommended. Setting strict stop-loss levels to meet TI